Hello, everyone. This is Kris Fleming with KFP Investors and our latest edition of Lender Chat. Today is July 20th, 2023. We are very happy to share some really important information with you today. First of all, KFP Investors is a licensed mortgage brokerage. We specialize in financing investment real estate. So if you are a real estate investor and you need some financing to scale your business and to grow, please reach out to us. Let me start with our disclaimer. KFP Investors LLC does not give legal, tax, economic, or investment advice. KFP Investors disclaims all liability for the action or inaction taken as a result of communications from or to its employees, contractors, clients, prospective clients, or participants. Each person should consult their own counsel, accountant, and other advisors as to legal, tax, economic, investment, and other advice. All right, now that that is out of the way, Bill Palte of Palte Insurance has been kind enough to join us today to tell us all the things that we should know and do not, all the interesting problems that he solves. Bill, tell us about yourself, please.
All right. Hello, everybody. Bill Palte of Palte Insurance. Very, very long story short. I have 25 years in the engineering world, 12 years in the insurance world. My target is in the investment space is to keep the investor in business because that's good for everybody. So within the insurance world, my plan is to develop a policy that matches your investing strategy or style, covers the requirements of the lender to make sure that you dot and cross everything that they need, and hopefully keep a price competitive so that it stays in the market for where you need to be. Located in Columbus, Ohio, Northwest Ohio. Lived in Ohio all my life, so I understand the rural community and all the things that go on, and also work in the metro areas because that's where the business goes a lot of times. So that's a long version short. And back to you, Kris.
Well, very good. Thank you so much for sharing that with us. And I know you mentioned that that you've lived in Ohio all of your life. My husband is from Ohio, by the way. Where do you work though? You work in more states than Ohio.
We are licensed right now in 15 different states, basically all the states around Ohio except for West Virginia. West Virginia is weird in a whole bunch of places. And then Maryland, Georgia, Tennessee, Illinois, North and South Carolina, Georgia, and Colorado, and Texas. So, and again, the philosophy is that if I can get a base of investors in a state, I have no problem getting licensed in that state because, again, my goal is to help you however it needs. And if I have a product that matches what your need is and the current or the local agents either can't or won't do that, I'll give you a shot to do it. Sometimes we're competitive, sometimes we're not. My opinion is at that point, at least you have a second opinion.
All right. And how did you get into insurance and what intrigues you about investment real estate?
Well, I got into the insurance world because in 2009, the automotive industry decided they didn't need me anymore. So I spent a year and a half trying to find a new home, connected with a farmer's insurance recruiter who had just moved from ADECO to Farmers as a recruiter. So our scheduled 20-minute interview was an hour and a half as we talked about all the things in life that go on in the manufacturing world and lead into the insurance world. And, you know, I bounced around a little bit till I got hooked up with the current gentleman I'm working with, Jeremy Ferguson of Farmers Insurance. We've been associated now 6 years, I think, or 7 years. And the interesting part of the investing world is way too many residential insurance agents try to treat the investors the same as the residential people. The investor world is totally different from the investor world. It took me about 1.5 years to figure that out. Once I got that through my brain on how the investor thought process works, I ended up and hooked up with a whole bunch of people that gave me some guidance on how and what to do with what it is. And at this point, it's just growing based on word of mouth and the fact that our target, as I said, is to keep the investor in business. So as long as we keep providing a product that's price competitive, covers all the things that they need to do, helps them run their business and or grow their business, then it's good for everybody.
So help me understand, please, what are some of the, when you talk about insurance agents try to treat investment real estate like residential and that it's totally different. Can you help me understand? I don't speak insurance. I speak real estate and I speak finance, but I have very little understanding about insurance except that I know that I need it. So what would be some of the more frequent issues that you find need solving in those scenarios?
The biggest difference between the residential and the investor is residential virtually 100% of the time by contract, the building is at full replacement cost. They don't have an option for that. If you say to a residential investor, I want my property insured at actual cash value, they're going to give you the deer in the headlight look. It's like, what are you talking about? We don't do that.
Right.
Most investors are looking primarily to cover their investment. So full replacement on a building may not be in their best interest because, and again, not to be derogatory, but quite frankly, they don't care. They want to make sure they have their investment. If I have a 4-unit building, the reconstruction value could be 600, 700,000. They're buying it for 125,000. They're going to put 100 to 150,000 in it to do the rehab to get everything leased out. They're not interested in paying the premium on a $600,000 building. Their maximum investment is $300,000. Their target is to keep the cash flow as positive as they can, but also make sure if something stupid happens, they have a claim that it's covered correctly and they get their money back out so they make sure that the building stays leased. Second part is most residential policies by contract do not do functionally loss of rents because they're not looking at that. If you have a single unit building, loss of rent can be a pain, but it's not a huge problem. You have a 4, 5, 6, 8 unit building, they empty that building out. Now you have a significant cash flow problem because you're losing $8,000 to $10,000 a month out of your cash flow. So different perspective on that. And also from the tenant standpoint, it's more critical because if you have a tenant that has a stove fire, you get smoke through the entire building, that building may be emptied out till they clean the smoke out. And again, you're out your income because that's just the way it works. If the residential agent does not understand those quirks on what you have to make sure that you, the investor, are correctly insured, you'd create a huge potential cash flow problem over something that you have absolutely zero control over.
Mm-hmm.
So from the investor standpoint, especially the newer investors, they don't understand the insurance. They really don't understand what they need or don't need. If a residential agent writes them a policy, they will not question it because they are presuming the insurance professional is
Mm-hmm.
doing correct by them, even though that person really doesn't understand what they're doing.
Mm-hmm.
So you can say, yes, I have a policy, everything is covered. I start asking questions, and probably 5 out of 10 respond, I've never been asked that question. If you haven't been asked that question, you now have a problem.
You know, that's really interesting because I would say that the differences between, as I mentioned at the beginning, KFP Investors is a licensed mortgage brokerage dealing exclusively in investment real estate. And we find the same thing when we talk with real estate investors who have previously dealt only with um, residential lenders. And so the approach is absolutely very different, and it is designed specifically for real estate investors. We ask very different questions, and we understand the mindset and the strategy. So, to your point, this morning, my admin sent a wire for the joint purchase of, I'm working with some other investors, and we are purchasing a single family home from a wholesaler with future development plans. And the retail value of that home is about $800,000, but our total investment is $500,000. So that's all that we insured it for because that's all we need. It's not going to be tenant occupied until the construction is complete. So we don't have loss of rents coverage because there's no cash flow coming from it right now. But that helps keep our expenses very low, just as you stated.
Well, and that's what you just described is the part that most investors miss, because
Mm-hmm.
until you have that conversation and understand the quirks, you don't know what you don't know, because
Mm-hmm.
there's nobody that gives you the guideline and says, here's all the questions that you need to ask before you step into this purchase.
Mm-hmm.
Um,
Mm-hmm.
the one that I recommend everyone have is there's a coverage called tenant landlord liability.
Mm-hmm.
And what that does is, in simple terms, if somebody says at some point, I want to lease your building, and you decide not to, they come back and sue you because you did not lease the building with them. The insurance company will help defend your decision. And most of the time, if you put that on the coverage, it's stupid cheap. It's like $10 a year or something like that.
Right.
And it matches the liability coverage of the policy. So
Okay.
in most cases, you can get $1 million of legal advice for $10 a year.
Well, that sounds like a good deal.
And it's all the little things that happen in the peripheral that
Mm-hmm.
should not happen, but occasionally do. Those
Mm-hmm.
are what makes the difference between having the property insured correctly or just having
Mm-hmm.
insurance.
And
My pet, go on.
that's interesting too. Oh, I'm so sorry. I was just thinking that it's interesting too because most real estate investors, the sorts of personalities and minds that are drawn to investment real estate tend to be innovators, visionaries, people who um, can see so many positive possibilities. But those personalities and minds often need a team to help them recognize potential downfalls and details and things that they may not think of that could be to their detriment. And so it occurs to me as you talk about that coverage for the denial of the tenant, I never thought about that before, about being sued for denying tenancy.
Well, it doesn't happen often, but
Hmm.
it could, especially if you get into a more desirable area. You get 8, 10 different people show up on your door and say, yes, we see you're rehabbing this building. When are you going to lease it? And how do I
Hmm.
get my name on the list to get into this building? Well, if
Hmm.
you don't meticulously keep the records, you now have the situation where you're not sure who you talk to when and what the pecking order
Sure.
is. You pull
Right.
somebody out
Right.
of sequence, and somehow or another they determine that they got passed over. Now you could have a
Hmm.
legal problem. And, you know, can it occur? Yes. Does it occur occasionally? I personally have never run into one, which is a good
Hmm.
thing. But, you know, it physically could happen just in a passing
Hmm.
conversation where you could have two couples that know each other at separate times try to get into the house and they pick one over the other. Now you have to
Hmm.
determine why you chose A over B and justify it if they decide they want to make a sink out of it. Most
Hmm.
investors, it's like, well, you know, that's never going to happen. Well, until the claim happens, you're correct. After the claim, I
Hmm.
can't fix it. And at
Hmm.
that point, if you don't have the correct coverage, it's your pocketbook.
Hmm.
And that can get expensive really, really quickly.
Hmm. I can imagine so. So, if I could, we did ask for our work to submit some questions in advance so that we could appeal to your wisdom for exactly what they would like to know. So, number one: what is your recommended strategy for ensuring all parties appropriately when buying subject to existing financing while raising fewest red flags with existing lenders?
The lender side I can't help with because, you know, the lender is definitely review the purchase contract,
Uh-huh.
because what we do on the insurance side on the subject to is we will take the actual verbiage of everybody involved from that contract and apply it to the insurance policy in the stated order that they have. And Miss Vina is notorious for writing paragraphs where there should be sentences. But, and what we request in that situation is to send us a copy of your purchase contract. And
Okay.
then we will take that data for the title so that it's exactly the way it's supposed to be put with all the quirks into it. And then for the additional insurance, mortgagee, and all the things that go in sequence, we will list them as they are listed on that contract on the insurance policy. Most agents, and I say this tongue in cheek, don't want to screw with subject to, because if you screw them up, you have a problem. The other thing is most insurance companies don't want to deal with the verbiage because they're not structured to do the verbiage. I had one earlier this week.
Hmm.
Somebody from the company underwriting sent me an email and said, you have 650 characters. We have room for 220. Fix it. I said, that is the legal deed title. I cannot change that. And she said, you need to paraphrase it. And I said, there's no way to do that. And she goes, so what do we do? And I said, it's your policy. You tell me what you're going to do. And she hasn't got back to me yet on how she's going to do it. But, and the auditor's office runs in the same thing. They got room for 55 or 60 characters, and you send them a whole 2 sentences, and they have no idea what to do with it because they don't know how to do it.
Right.
So what they
Right.
do on the auditor side is they actually do an addendum to the deed that lists out all the details. And that's why I suggested to the insurance company, it's like, here's a copy of the purchase agreement with everything spelled out. Do the addendum, add it to it, and say, here's the deed with the people involved. Any questions, see the extra sheet attached, and that gives all the details to it. And the problem that we run into is the more creative deals that you run into, especially with the IRAs, 401ks, and all that, you end up with physically paragraphs. And it's neither good nor bad. It's just the way the deal is functioning, and you deal with it as it is.
Right.
I know at least a half a dozen insurance agents that won't mess with them at all. It's like, no, I don't want to do this here. You do it. And they're not complicated. They appear really, really intimidating, but it's a really short process. It's copy and paste physically. So, the subject to 2 things is make sure the purchase contract spells out everything the way it needs to be. And number 2, read through the lender documents and make sure that there's no quirks on there. One to be aware of on a subject to is if it is an existing loan on a single family property. Almost all of those have lease limitations and or exclusions in those. If you are not aware of that, do not read that document. They find out you're leasing, they can call your loan. And there isn't a thing you can do about it. Some of them have time limited. Fifth Third, I think, has that you can't lease it in the first year. Some of the others go either 3 or 5 years. But definitely on a subject to review all the paperwork before you step into that agreement, because you may be creating yourself a nightmare that you're not even aware that exists.
Bill, I have to tell you, we've been talking for 20 minutes so far, and I have already learned so much. Thank you. And it occurs to me as well that I should have described for our listeners what a subject to purchase is for those who may not know. So for you real estate investors who are not familiar with a subject to and have maybe done more straightforward lending so far in your business, if you are buying a property and you are keeping the seller's mortgage in place and you are going to pay their mortgage on their behalf as part of your financing deal for the acquisition, then you are purchasing the property subject to the seller's mortgage. So that's why we are addressing how to make sure that all parties are properly insured when you own the property, but they own the financing, or they're responsible for the financing. So the lender has to be properly covered, the seller has to be properly covered, and you have to be properly covered as the real estate investor. So our next question, Bill, did you have anything you wanted to add to my description?
No, that what you described is exactly correct. And again, that's where always refer to the purchase contract from your attorney. Any questions on dotting, crossing, any of that goes to the attorney first, because until they bless it, it doesn't mean anything.
Thank you. Question number 2, is a large umbrella liability policy then minimal per building liability, all with the same insurer, still a cost-effective and advisable approach for a portfolio? To break that down for us, Bill, what does that question mean?
Okay, first, what an umbrella policy does, an umbrella policy is physically a second insurance policy over another insurance policy. So if you have your rental unit insured and you said, okay, but I'm really not comfortable with this, how do I make sure they can't get to my house? First of all, make sure the legal entity is set up correctly for what it needs to be. And that's an entirely different discussion with different people. But once you have that in place, then you can buy additional insurance coverage over the entity and or over the individual property. Most umbrella policies require a minimum of 300,000 in liability coverage. Some of them require 500. Depends on the carrier. Umbrella policies can go from anywhere from $1 million up to $10 million. The biggest thing that I recommend, again, not to abuse the attorneys, but ask your attorney, if I have a liability claim, somebody falls down the steps, what is my risk? What can they get? And have him explain from a legal standpoint, if there is an exposure, where the exposure is. Most of the time in those conversations, he will say your premises liability is to here. You should have an umbrella over this to protect that, to keep them away from your primary residence. The logic, whether you agree with or not, is if it becomes a large injury claim and they decide what you have as insurance on your individual property is not sufficient, they want to go after the next level to get whatever amount that is. If you have the umbrella, in a large percentage of the cases, they will not exceed that as a way to challenge. They won't go after your house. And again, that's where the structure, the legal structure can limit that, because if you have that within the umbrella, have the liability on your house, the umbrella policy, both within your LLC, they can't go beyond that without creating a whole bunch of other issues, which is why the LLC is put into place to start with, is to separate the liability from everything else that goes around it. How you have that structured is between you and your attorney, what you want to do, whether or not do. If you have multiple properties, understand that we can put the umbrella over the multiple properties within the LLC. But if there is a large claim, they can go after the other properties under that LLC before they get to that umbrella policy. And again, that's where your attorney has to make sure they explain to you what your liability exposure is on that property, the other properties, and also on the umbrella. The umbrella itself is a really simple thing. It's just a simple insurance policy that insures everything that's listed on it, whether it's your house, cars, boat, other properties, whatever it is. That particular policy doesn't care. It just says whatever you have listed, that's what falls under the scope of the umbrella. As an overview, if you have investment properties and you don't have an umbrella policy over that, technically your house is at risk. And I get multiple people, it's like, well, I don't need an umbrella policy, it never happened. I said, well, do you like your house? And they said, well, yeah. And it's like, okay, but if, and again, worst case scenario, not to scare people, but this is the example I use. You get a 6-year-old and falls down a stairway, ends up in ICU with a severe head injury. What's that worth? It could be, $1,000. It could be a couple $100,000. It could be 10 million, depending on what the injury is and where it goes. Bottom line is you own that injury. The question is, how does the family get compensated? How does the person get treated, and all the things that go with that? That is an attorney discussion. The attorney has to tell you how to make sure that scenario, if it occurs, does not physically ruin you. Then you make your determination from there on what you need the insurance to do or not do.
Mm-hmm. Mm-hmm. Well, that is the nature of insurance, right? When people
100%.
say, "Well, yeah, that's never going to happen," but that's the point of insurance. That's the whole purpose, and that's what drives premiums. Is how many times it happens becomes more expensive.
Amen to that. Yes.
um, so, question number 3. Can a housing provider force place tenant insurance and include in lease payments if outlined in a lease? Will most landlord policy carriers also carry tenant policies so there is less finger pointing among carriers at claim time? And if you would start by unpacking some of those terms and describe to some of our audience what is this question even asking?
Okay. Tenant insurance, simple terms, is renter's insurance. Everybody has their own flavor, but that's what that works out to. The forced place is where an entity by contract says you must have insurance, and if you do not provide the insurance, I will provide it for you. To say that the housing provider, well, let me back up. On renter's insurance, the renter, the individual, that tenant, has to have that policy in their name. You cannot buy a policy in somebody else's name as a renter's policy. The renter or the tenant must sign that policy and accept that how the premiums are paid are between you, the property owner, and the tenant. However you work that out, whether it included in the rent payment, if the tenant pays it, functionally from the insurance standpoint, that is irrelevant. But the two big ones is the name of the tenant has to be on the renter's policy. They have to sign that document. If they do not do that, you have created an insurance fraud case, and if somebody wants to make a case out of it, you have a legal problem, more ways than one. If the tenant says, yes, get me a renter's policy, you can purchase it, but it still must be in the name of the tenant. The tenant must still sign it. And again, the insurance company doesn't care who pays for it as long as the policy is issued, signed, and the rent and the premiums paid. It's irrelevant. As far as force placing that would become a term of your lease. If your lease says you must have, and we will hound you until you do, then it's a question of whether you chase them down, physically buy the policy, get them to sign it, and all the things that go with that. Sometimes it's worth it, sometimes it's not. As far as most landlords require the renter's insurance, I would say statistically 75 to 80% do not enforce it because it's a real pain to enforce, because just all the stuff that goes into it. The renter's insurance, as a property owner, you want to make sure that you're listed as an additional insured on the renter's policy so that you're notified if payments aren't made, if there's anything that goes on with it, and on and on. As far as whether you functionally must have that, if you're in a single family property, personally, it's not as critical, because anything that goes south is only affecting the physical person and the tenant. Multi-families, I would be really anal about getting that in place, because a single tenant can empty your building. Now you have problems. An upstairs tenant that floods their bathtub now has a problem, because now you got 3 units that are empty instead of 1. So
Mhm.
you have to look at your individual building, what your risk is, all the things that go with it. We do have a company that offers a version of tenant insurance, but it is based on a premium per door, not per person. It's more expensive than what I would like to see it as, but it's an alternative that gets out there. So if you have a multi-unit building, you have a four, you buy 4 units of that policy, covers up to $100,000 of liability in each unit, but it is not assigned to the person in that unit. So if you rotate tenants, the policy stays the same. You don't have to worry about it. Is it a fail safe? Yes. The cool thing on it is it does include water coverage. And that's a big reason that I push it, because from my experience, a water claim is your biggest risk in a multi-unit, just for all the stupid things that go on. You know, it only takes one thing to happen and you got a 4-month nightmare trying to fix it. At least you'll get some coverage on it, different to what the sewer and water backup coverage would be on a standard policy. But again, it gives you an option to do that. And depending on what you have on the insurance policy, some insurance policies, for whatever reason, and I deal with several companies, do not offer sewer and water backup. And I don't understand the logic of it, but you know, if I have a property owner that's buying purely on price, sometimes it's more effective to do that, and they
Mhm.
understand that they're not getting all the coverage that they should have.
Mhm. I actually have two close personal friends that both experienced sewer backup in their homes. So, y'all, I'm just going to go ahead and tell you right now, make sure you have that coverage, friends, because
Well,
it's pretty awesome.
in the state of Ohio, the last number I saw, the average sewer and water claim is about 32,000.
Mhm.
The average person who has sewer and water coverage has a limit of 5,000.
Oh, wow.
Yes. The other stupid quirk in the state of Ohio, if you actually have sewer water back up into your basement, by law, the restoration company has to destroy everything it touches. So if you store stuff in your basement and you get a sewer backup, by law, they have to discard everything that's there. Most of the service companies, when you call them and you say that it is sewer, they will tell you, what we don't see, we can't do anything about. So anything you want out, remove it before we get there, because once we're there, our hands are tied on what we can do or not do. And I've heard some stories that have been real interesting, but you know, that's again a different discussion.
Mhm.
Real simple thing in a basement, other than furniture, nothing less than 12 inches off the floor. Build shelves, racks, whatever you got, always be at least 12 inches up. That will eliminate probably 90 to 95% of any damage that you have to that. If you store stuff on the floor, you're glutton for punishment.
Right, right. I'm thinking about the wire metal shelves that I bought very inexpensively
Yep.
at the hardware store that line our storage area, and all the stuff that's sitting on the floor underneath the bottom shelf needs to
No.
go up. Nothing on the floor.
Yeah.
Got it.
I just don't put anything on the floor. Um, if you have furniture and carpet down there, you got enough of a problem just fixing
Mhm,
all of that. I
mhm.
heard a story one time of a lady that had 3 or 4 rows of pictures in boxes in her basement. Uh, the last I had heard on that, she had paid somewhere north of 150,000 to some company in Chicago to resurrect the pictures.
Wow.
That you send them the picture or the box sealed, and they have a drawing process that they do that it's a 2 to 3 month process, but they say they can save almost 100% of everything. That it's a really, really, really intense process, but there are companies that can save those materials.
Right.
It's like,
Whereas
no,
those
just put it
wire
on a
shelves,
shelf.
yeah, they're about $40, $50.
Yeah, but for $50, you can put a lot of shelves in a basement.
Yeah, yeah. Oh, wow. Oh, that just hurts my feelings so much. I did not recognize in advance, Bill, how much anxiety this conversation was going to give me. I'm gonna have to take the rest of the day off. I'm feeling a little
Well,
nervous about life.
part of what I get blamed for all the time is making people think. And again,
Yes, I'm taking notes. I have homework. Yes.
well, see, I look at my world as 80 to 90% education,
Mhm.
10 to 20% actually processing. Because again, you don't know what you don't know.
Mhm.
And without having those conversations, being that the 98% of the people never read their insurance policy, never see that, they don't know what's there because you don't know what to ask.
Mhm.
My recommendation on insurance policy is the first thing you do with a highlighter in your hand, read the exclusion page. Second, you read the limitations page.
Mhm.
Highlight anything that trips your trigger as you're going through it. Once you're through those, then go to the front part of the policy and make sure that it covers what you need to have covered.
Mhm.
What you will find is when you go through the exclusions and the limitations, you now have an hour conversation with somebody because there's all kinds of things on there. What you thought were is not. And
Mhm.
you need to have somebody explain number one, okay, yes, I must have this. How do I do this? And
Mhm.
you can add a lot of things to an insurance policy. It may be that you have an incorrect insurance policy for what you're trying to do. There's
Okay.
multiple versions of everything. But again, if you don't understand what you are covered for and what is
Mhm.
excluded or limited, you don't know if your policy is accurate or not.
Mhm. I don't know that I ever thought about that either, that I could ask for things that are not in there. I think a lot of this think about, like you go to the store and you buy the package off the shelf and it is what it is, and you decide if that's the price you want to pay. I don't know that a lot of us think about, oh, but you can add this piece to it and this piece to it and take this piece away. Um, I don't know that a lot of us were aware of that. So that's very interesting to know, Bill. Thank you.
Well, the to continue that thought, your insurance policy is a living document physically. You can make a change anytime to almost anything on that document if you so desire. I run into a situation that I've done it myself where we have a 1 day party at the house. I will increase my liability coverage for that day just to make sure that I'm covered for physically everybody on the property. The day after, I reduce it back to where it was. Do you need to do it? Probably not. Does it give you comfort? Yes, definitely. Because when you go from $500,000 to 2 million, yes, I'm covered if anything stupid happens. Net effect is it cost me $3 to make that change for a single day. If you buy a standalone event policy, you're probably going to pay $60 to $70 for exactly the same thing. So,
Really?
and again, it's how you make that living document work for you.
Very interesting. Yeah, I really do have a page of notes here. You've given me a lot of things that I need to go work on personally. Um,
That's what it's
so
all about. The education is really
yeah,
cool.
yeah. And I believe my admin emailed to you our policies, so you can take a look at those and see if we need to make some changes regarding those business
Yeah,
policies as well.
I've added you to my list.
Thank you. Thank you. Um, so, final question from our network, and then I have one of my own that may lead to more. Final question from the network. Um, Please remind us all about replacement value and the best alternatives for a landlord.
Replacement value, in simple terms, is what the insurance company thinks your property's worth. And that
Mhm.
is the building only, not the physical land. What we run into a lot of times is we get somebody, especially on a new purchase, they buy a $300,000 lot with a $600,000 house on it. Well, by contract, I have to insure that for $900,000 because that's what the purchase is. Realistically, you only need to insure for 600 because that's what the building is. The land doesn't care. The land's not going anyplace. So if you have a claim and the building is totally destroyed, the claim adjuster is going to come back with an offer of 600,000, and you're going to say, but I paid 900 for this. I'm getting screwed on this. It's like, no, because we don't care about the ground. All we're doing is putting the building back. So we have lots of conversations on those. It's like, well, that's not correct. My building's 900. It's like, no, the lot with the building is 900. Totally different structure, totally different payout. So like I said, replacement cost is what the cost of the building is for the insurance company to put it back in place. As a property owner, now you get into the subject thing, as you mentioned earlier. I have a purchase price. I may or may not have a rehab with it, and I have a street value. Then the next version is I have an ARV on it. The ARV, the street value, purchase value, and the unrehab value are all different, can be significantly different. Which one is correct? That's entirely up to you, the investor, and what your mortgage company runs into. There is not a correct answer. My philosophy is I tell people that ask me, what should I insure it for? I said, okay, use $1 million because it's a good round number. You buy the place for 300,000, you got to put 200,000 into it, so it gives you a net of 500 rehab. It's worth $1 million, but the street value is probably $750. So what do I insure it for? I say use the sleep factor. If you can sleep at night and not worry about that building being destroyed, you're good. If you wake up at night and say, if I have a fire, yeah, you got it insured incorrectly. You need to have that conversation. Not that it's right or wrong. I can give you a suggestion on the value. By law, I physically am not allowed to tell you what to insure that building for. I can make a
Oh, that's interesting.
recommendation because, again, it's your building. I'm the middleman. I could say you need to insure for $2 million. That's my opinion. You're the investor, has to determine what makes sense or doesn't make sense. And that's where, again, you look at your situation on, what works. In the situation of a 300 building with 200 rehab, I would probably recommend insuring it between 550 and 600, because if it totally goes to crap, you are going to spend money to clean it up. If you don't have some money in that process to do that cleanup will be out of your pocket. And depending on the size of the building, that can be substantial. Or as one of my investors says, at that point, we bring in the backhoe, we dig the hole, fill it up, level it off, call the city and say, here's your lot. Thank you for your interest. And it's now yours. So, yeah, we got some interesting people in the world.
Yes, we do.
So
Yes, we do. And a lot of them are real estate investors.
I think all of them are real estate investors. But again, there is not a right or wrong on what you do. It's, are you comfortable with, do you meet the legal requirements of your lender? Do you meet the legal requirements of your attorney? And does everything fall into place the way it's supposed to? If your attorney and your lender are okay with it and you can sleep at night for how you have it insured, you're probably okay.
Mhm. So one of the things that I find as we, are working to acquire funding for on behalf of our investor clients is that we typically see that underwriters want to see that the amount of dwelling coverage is at least the amount of their loan or at least the replacement value. And so we regularly ask for those documents, and often we have to ask for a replacement cost estimate. And some companies will tell us they don't provide those, and some just snap it right out and it's not a problem. So why is that? Why would there be companies who tell me they can't provide an RCE?
Because they're lazy. I didn't say that.
Is that it? I
Uh,
suspected, but I wanted some ammunition.
a reconstruction estimate, um, depending on the type of property, takes you anywhere from 8 to 15 minutes.
Really?
Yes,
Okay.
it's because there's online calculators. Every insurance company that offers any kind of residential coverage has a calculator built into their system. There's at least 4 different brand names that are out there. It's a very simple process. Like I said, it takes 15 minutes if you take your time. And then it's a question of how much manipulation that you do to get to whatever number you need to get to. It is
Uh-huh.
not a, and again, not to discredit insurance people, but a large percentage of them are just freaking lazy. They just want to do the minimum, get through. As long as you give me a number, I'm good. I run into a lot of agents that will not write insurance policies for flips or rehabs. And it's like, well, because I had one lady call me and she goes, well, he said he would write my rehab, but I needed to put my house and cars with him also. And she goes, I ain't moving, because she said, I like God, I don't know why he's doing that. And I said, well, let me give you a simple scenario. Average insurance agent on a policy makes somewhere between 8 to 10% on commission. Okay. If I write a policy for you as a rehab that you have for 2 months, I get paid that monthly premium at 10% for 2 months.
So
I ain't
not
getting paid
much,
for it.
right?
I'm probably spending more time writing and issuing the policy than what you're going to pay me for commission.
Right.
A lot of residential people, it's like, no, I ain't going to do that, because again, my opinion is they're exceptionally short-sighted. I'll write a rehab for anyone because I know statistically, if I keep their problem properties insured, at some point, everything else will follow. It may take 6 months, it may take a year, it may take 5 years. At some point, their existing agent is going to screw something up. They now have a relationship with you because they talk to you every 5 to 6 months when they do the new property. They get educated on what they should do, shouldn't do, why we're doing, all the things that go with it. And at some point in their brain, it's like, so why am I dealing with this other guy who doesn't really understand anything that I'm doing? So
And doesn't
I
help
end
me
up
with my
with
real problem.
right. And
Yeah.
that's why I do. And I would say statistically 95, 97% of agents will not write flips specifically for that reason, because, you know, I make 25 or 30 bucks on it. Yes, I'm not going to get rich off of it, but I know in the long term, it's going to work out to my advantage because they keep churning it. The other side you get is like, you know, they do 5 or 6 singles, and then all of a sudden they decide they want to grow up and they buy a 10 unit. Well, that 10 unit they're going to have for 8 to 10 months while they rehab it. I'm going to make a decent amount of money off of that because I did all the simple ones and covered what they were doing at that point. When they get done with that 10 unit, they're now going to lease it in probably 75% of the time. And now I have a leased building that's going to pay me for as long as they own the building. So, yes, you have to put up with the quote unquote ugly on the front side, but you know, it is what it is. I
Right.
want to back up real quick on a replacement cost. I get people all the time that say, well, I got a replacement cost from this person, it was 400, and somebody else gave me a replacement cost, it was 200. You know, so like, I don't understand that. You have to understand replacement cost is a moving object. What we have to do as an agent, if we want to insure the property at replacement cost, the insurance industry requires our value to be within 80% of what their adjuster calculates. So if I have
Okay.
a 1,500 square foot house and I say it's worth $310,000, it totally burns down. That reconstruction estimate could go up to 380 or 390 and still be listed as fully insured replacement value. If I insure it at 100, the claim adjuster says it's 200. I now have an E&O problem. You also have a problem because you're only going to get a third of what your loss is. Not that it's right or wrong, but you have to understand that's what that value is. Second thing is there's a clause on a number of policies called co-insurance. Co-insurance, in simple terms, in my world, means deductible. If you have a house that's insured at 80% co-insurance, which is pretty much what the industry value is, they take 20% off the top. So if I have a $100,000 property with 80% co-insurance, your maximum is 80,000 minus your deductible, even if the house is totally destroyed. If you do the process correctly, when I get ones that to get the 80% I can't get past, I will increase the structure value by 25%, so that when they take the 80% on the calculation, it comes back to the number where I want it to be. You have to play on the numbers a little bit to get it. But again, my target, if you want full replacement, I have to make sure that my number is your street value full replacement, not a fantasy number. If you see co-insurance less than 80%, the agent is adjusting the premium so you buy, not that it's to your advantage. Because the lower that number is, the more you pay out of your pocket. If you ever see one at below 70%, my personal opinion is I would not use that agent because he's manipulating that policy so you buy the policy from him, even though you're getting penalized.
Lots of education happening here this morning, Bill.
And
Lot.
I've seen co-insurance as low as 60%, which is scary because you got a 40% deductible up front. And it's like, why would you do that? And it's like, well, the agent said it's no big deal. I said, no, on a $200,000 house, it's only 80,000. You're right, it's no big deal.
Yeah, no big deal with them.
But anytime you see that number adjusted down, the agent is working the policy to his advantage, not yours.
Mhm. Gotcha. And so my own personal bane when it comes to investment real estate financing is so many of our clients have, even if they don't live there, they have a couple of properties in Florida. What is the deal with getting insurance in Florida? What happened? Why have premiums, increased 8 and 10-fold in the last few years? What's happening?
Oh, they ain't seen nothing yet.
What prompted this?
FEMA, pure and
Okay.
simple. FEMA right now, and I may be wrong, but I think the most FEMA will pay on a hurricane damaged property, I think, is 500,000. It may be up to 750, but that's the most they would do. But if they declare the area a catastrophe, it goes into a different category, and then the federal government physically throws more money at it. Okay.
Okay.
Used to be 250,000 on the building, which is when you got a $2 million house, 250,000, it's like, okay, it's pennies, it's irrelevant.
Right.
But if I can have a $3 million house on the beach and every 10 years the government's going to redo it for me, and all I have to do is pay my flood insurance, I got a hell of a deal. The problem is the state and the federal government are spending physically billions of dollars. That is your taxpayer money at work. It has got to the point where the insurance companies are saying, if you, the government, are subsidizing these people, I'm not insuring their property because I'm paying a bill that you're going to make sure their property is rebuilt, but they won't pay me for what the building should be insured at. So I'm done. You're on your own.
So that's why so many major insurers have left Florida.
Because they're physically losing every hurricane, they lose millions, hundreds of millions of dollars. And they've got to the point where, from the actuary standpoint, it's like, this makes absolutely zero sense. I'm not doing this. The group that will end up doing insurance probably in the next 2 to 5 years, probably 2, is going to be on the long side, is called Citizens Insurance, which is a state-run exchange. You will
Okay.
have no option. That's who you will buy your insurance from.
Right.
And
Right.
basically, it will be a state-run agency that will be your only option to get insurance. And kind of like the ones that's got the no-fault car insurance, you're going to pay much higher premiums because they're insuring absolutely everything to whatever value it is, and you have no choice. The good side for the average person in Florida is all the high dollar property owners are not going to have to pay their fair share. The downside is there's going to be a whole bunch of $3 to $5 million, $10 million properties in the next 2 years that are going to be for sale because the people are going to bail out. And that will create a whole another problem because when they go, their income goes, their spending goes, and then it's going to get real political, and then they're going to readjust it. I don't think it'll ever get fixed. But, there is no simple solution to it other than physically let Florida go back to swampland and everybody move north.
Well, that's another thing too, right? My husband showed me a news article about a 300-pound Burmese python. I think it was some kind of python that was
Yep.
found in the Everglades the other day. And I was like, yeah, no, that's not my backyard. That's not where I'm going. But I'll tell you, every time we have a client at KFP Investors who's looking for financing to purchase a property in Florida, my first question is, have you checked on insurance yet? Because so many people, once they check on insurance, they say, never mind, I'm not buying in Florida. We had
Yep.
one about 14 months ago. It was a triplex on the beach. And we had to um, increase the deductible to $20,000 just to make the premium palatable so that we could get the loan through underwriting. It was,
Yep.
I mean, it was a $1.5 million property. You're right, but yeah, a $20,000 deductible was fairly significant. I don't have that on my house, and I don't
Yeah.
want that on my house. So
Well,
yeah.
the thing most people don't understand in Florida that are not there is
Mm.
there are 4 different deductibles for the roof. You can
Okay.
get a deductible for the entire structure. You can get a deductible for the structure plus wind damage to the roof. You can get a deductible for wind and water damage to the roof. And you can get a deductible for hurricane only damage to the roof. So depending on which of those deductibles you get, yes, there can be a $20,000 to $40,000 swing in the cost of your insurance.
Mm-hmm.
If you
Mm-hmm.
just get hurricane coverage and your house gets destroyed by a tornado, you have no coverage, or vice versa. So,
Right.
I had a client, I don't know, it was a year and a half ago, look at a $750,000 property right on the edge of the Everglades for an Airbnb.
Mm-hmm.
Her insurance, the lowest I could get was $28,000 a year.
Mm-hmm.
I said, beautiful house, just don't insure it. And she goes like, I can't do that. I said, that's your only option because you can't lease it for enough to pay for your insurance cost. And
That's
she goes, what? I
exactly
said,
the discussion.
you're going
Yeah.
to have to do $1,000 a night. And I said, where you're located on this, you could probably get that because there's nothing else around it physically.
Mm-hmm.
And she goes, nah, that ain't gonna happen. I said,
Mm-hmm.
and she goes, what's the alternative? I said, contact an insurance agent in Florida. But I said, he's going to give you the same numbers I gave you because that's where I got them. And
Right.
she called me a couple weeks later and it's like, nah, I'm not doing this because I can't make the numbers work. And that's only going to get worse as
Right.
they go into the state run thing.
Right. Right. Well, Bill, thank you so much for all of the enlightenment and wisdom you have shared with us today. I want to be respectful of your time. And I have definitely used more than my allotment of it. But thank you so much. I really, really appreciate it. Before we let you go, will you please tell everyone how they can reach you?
The best way is going to either the CORE or the GC RIA site and look up because all my contact information is on there. Phone number is 419-890-1270, or you can do my email. That's my name, Bill Palte, Palte, at palteinsurance.com. And we do text on the numbers and email, and if you want, I can give you the other 5 emails that I use, but that'll give you enough to get it in. The biggest thing on the insurance is ask any question that pops into your brain.
Mm-hmm.
If you think a situation could occur, whatever it is. Contact your agent and say, okay, if this situation occurs, what is my cost and how does it get covered?
Mm-hmm.
If they can't explain that to you, you have a problem.
Mm-hmm.
Because either they don't know or they don't care to share what they have, and both of those are not good, because it's just like purchasing anything else. If you don't know what is wrong, if things go south, you're never going to be where you should be, because the incident will occur. It's just a matter of when it will occur. And my goal as an insurance agent is to make sure you understand 100% what your cost is. If you don't understand what your cost is and you buy a policy just because you like that number that's on that policy, that's really dangerous.
Yes. And I think that's what most people do.
Oh,
Yeah.
way too many people buy 100% by price.
Yeah. Yeah. They just check mark a box. Okay, that's done. Move on with life.
Well, I did a quote for a California investor 2 days ago, and he responded back that the insurance had to be less than $100 a month. And I responded to him, you're buying a $650,000 building and you're worried about $20 a month. Maybe you need to reevaluate your deal. And I'm sure I'll never hear from him again. But if you don't have enough money in your deal to pay that, and I have no idea where that $100 came from, personally, in his situation, I would have done my estimate with $200 a month, just because it is. And I told him, I said, take whatever your numbers on your spreadsheet, increase it by 15 to 20% each of the next 3 years, because that's what your insurance is going to do. And I don't see that stopping. Unfortunately, a lot of investors that are just barely breaking even on their deals right now, come next year, they got a problem because they have to bump their rents 15 to 20% to make the deal work. And that just escalates a whole bunch of problem and bad press and all the stuff that goes into it. But in today's inflation world, if you are not proactive on that, 3 years from now, you won't have a business.
Well, thank you for that advice and for all the advice that you've given us today. We will definitely be in touch, and I will speak with you soon about once you've had an opportunity to review my insurance.
Yep.
So
I appreciate that, and I will send you my invoice as soon as we get off here.
all right. Thanks, Bill. Have a great day.
All right. Appreciate it. Thank you.